If you're serious about buying your next home and you want to make sure you're not only protected through the entire process, but you also get the best deal possible, this video is going to be for you. So I just recorded myself going through our entire buyer strategy session. Now, this is normally something we only do on a one-on-one, and honestly, I hesitated almost making this because I couldn't take your real context, but I did my best going through our entire strategy playbook, how we get our best deals, how we negotiate, how we get our clients prepped and ready to go. So this entire video is a long one. It's got a ton of different information in it. So make sure you bookmark this and come back to it later because you're probably going to need to. But anyway, let's go ahead and jump right into the video. And if you want to book a strategy session with our team, make sure you fill out the form, click the link, do the thing on the page, and I'll see you in the video. All right, so let's dive into the buyer strategy session. Here's an agenda for what we're going to talk about today. First, we're going to talk about getting to know you in your unique situation. Normally we would do that, but today I'm going to kind of skip past that because obviously I can't talk to you. Now, the second thing we're going to talk about is how our clients are taking advantage of the market. We're going to talk about how we keep you protected, and we're going to talk about how we negotiate you the best deal possible under whatever the circumstances are. And then again, because we're not here, the end, we'll talk about what it looks like to work together. I'll share some stuff about our team as well. But here is some stats. I mentioned this early in the video, but here are some real life stats that we update these every once in a while. But we've helped well over 620 people all over the Southern California market. Total sales volume is over $585 million. And one of the things we're most proud of is we have over 400 five-star reviews, which means 2/3 of all of the clients that we work with leave us a 5-star review. And this is all just since 2020. So to say that you're in good hands is maybe a little bit of an understatement, but I just want to make sure you know that we know what we're doing. Now, when I say our team, I'm talking a little bit different. A lot of times when people think about hiring a real estate agent, they're doing just that. They're hiring a person, a real estate agent, to help them with everything. And with us, you're hiring a whole team. So Onyx Homes is a team of real estate agents, and we help you out. And there's a lot of different ways. So first and foremost, we have showing agents. So if for whatever reason the agent that you're working with is not available to help you out, we have a team of 50 plus agents. Somebody's going to be able to make sure that you can get in to see property when is most convenient for you. Now, the next thing is we have a transaction team as well too. This is complimentary for our exclusive clients, and this is also in-house, in our office and on our payroll. And the reason that I say that, a lot of other agents that'll outsource this or even, God forbid, charge you for the service and outsource it to somebody that's a contractor. We also have a marketing team. This means that we find hundreds of off-market properties for our clients every single month. Not guaranteeing that we're going to find you one. We just find a lot of them. So there's a lot of opportunity to find one, even though most of our clients find their properties on the market. It's just because there are more properties, obviously, but we do find those opportunities all the time. And we have a team leader dedicated to luxury experience, luxury service. That would be me. Let me go through this very quickly. Market knowledge and property tracking. One thing we set up with all of our clients is a custom home search. If you don't already have this set up, I would highly recommend going to our website, getting your search set up so that we know what you like and don't like without we having to bug you. Now, we would normally want to know how you like to be communicated with, what your timeline is, and what you're looking to change about your current living situation, and also try to figure out where you're kind of at as far as a timeline. Are you really researching? And you can answer all these questions and figure out where you're at, right? Are you finding a house tomorrow, or are you just starting your research phase? Wherever you're at, we're happy to help. So we always want to make sure we understand that. Now we're going to dive into the really important part here, which is understanding the contract. Now, I know contracts are boring, but what we're going to do is we're going to go through how we can use this and make this a weapon to make sure that your offers are accepted without you just paying the most money possible. Okay. Now, before we get into the actual meat and potatoes of the contract itself, anytime you're submitting an offer, there are a bunch of disclosures that are in the front. So I always like to explain these. So this first one is what is called a disclosure regarding real estate agency relationship. So there are two different types of agents in any real estate deal. There is a seller's agent, and their job is they're hired by the seller, and their job is to sell the house for as much money as possible and to protect the seller through the entire process. It's the seller agent or the listing agent. That is their job. Now, the other person involved would be the buyer's agent. Now, this would be us if you chose to hire us to represent you through your next purchase. And our job is, regardless of whatever house you buy, to make sure that you are protected through the entire process, you get the best deal, and to make sure you actually get the house that you really, really want. That is our job as a buyer's agent. Now, I have this question down here at the bottom because most people don't know how real estate agents are compensated, and things have changed rather recently, so I'll go ahead and explain. A seller's agent or a listing agent is hired by the seller to sell the house for as much money as possible and to sell the house and protect the seller through the entire process. The seller will usually pay a fee. It's usually a percentage of the purchase price to that listing agent to represent them. Now, most sellers nowadays, and this is how it's pretty much always been, but most sellers nowadays are also choosing to compensate the buyer's agent so that it is easier for the buyer to purchase their home, right? So by the seller choosing to compensate the buyer's agent, so again, that'd be us if we chose to work together moving forward, the sellers are compensating in almost every single 99.9% of transactions that we've seen. Unless the buyers choose to compensate the buyer directly, the sellers are choosing to do that, and it's because it makes their home easier to buy. So that is how compensation works. So the seller hires a listing agent, and the buyer is represented by a buyer's agent that is usually compensated by the seller. Buyer can compensate directly as well too, but normally, literally 99% of the time, the seller chooses to do that. So I hope that makes sense as far as who is who in a transaction. Now, one thing I will point out is through disclosures, anytime something gets mentioned multiple times, I always like to be aware of it, or make my clients aware of it, I should say. So the one thing, this is going to be brought up several times, so I put a buyer beware here, is what is called dual agency. Now, California is one of the few states that actually does allow for dual agency. Now, what does that mean? It simply means that a listing agent or a seller's agent can represent the seller to sell the house for as much money as possible and to protect them through the entire process, and represent the buyer, and then somehow negotiate them the best deal possible and protect them through the entire process. And if you're wondering how one person can do both of those, that is why there's a big fat buyer beware on like 5 different pages throughout the contract. I can give a million different analogies here, but for time's sake, I probably won't. The next slide on here is just be a good person. If you've talked to friends, family that have bought in the past, or maybe you have as well too, and you're thinking, hey, I need to write a love letter to say how wonderful me and my family are, this is something that's not allowed anymore. Years ago, this is probably 4 or 5 years ago now, the Fair Housing said, hey, no more buyer letters on offers. So if you had somebody telling you about that and you wondered why we didn't mention it, well, this is why. It's because it's not allowed anymore for discriminatory reasons. Now, instead, we actually write a love letter about how wonderful we are because we want to show the listing side that we're going to make their life really easy. We're really easy to work with, right? So that's what we do there. Now, again, here's another buyer beware. This disclosure is called possible representation of more than one buyer or seller. Basically what this means, I usually make a joke here. I hope you don't feel like we have more than one client, but we do. But this basically just says that agents can work with more than one person at a time, and more than one person might actually like the same property. So how we operate is anytime we're working with a client, whoever is under an exclusive agreement is who we represent. If somebody else is interested in something and they're not an exclusive client, then that person we would not obviously represent that person. The other thing that's mentioned on here, again, is dual agency. Again, this is just a reminder that if it's mentioned 3 or 4 times in the first 2 or 3 pages, it's probably not the best idea to do. This page is a wire fraud advisory. I highlighted the entire thing not to scare you, just to share that there is a huge, anytime you're dealing with a large sum of money, there is a risk for frauds. We just want to make sure that you are protected through the entire process. Anytime you're wiring a large amount of money, you want to make sure you're going through every precaution. We'll talk about that in a little bit. Now we're going to dive into the actual offer. So if you're wondering what actually happens in the home buying process, this is what we're covering right now. So this first page is, I always make a point here. If you can see at the top left, I think you can see my mouse here, but if you see up at the top left here, this California Association of Realtors. The important thing to mention here is that almost all of the paperwork that is done in a real estate transaction, or at least all the paperwork that comes from real estate agents, is on standardized paperwork. So the California Association of Realtors is the one that writes all of the contracts, and they are, as you can see, kind of fill in the blank style. Now, the reason I mention this, it's not like every single real estate agent is writing up their own contracts. We're using fill in the blank. Now, everything is still negotiable. However, I just make that point because every single deal that's done in California is done on the same paperwork. So the contract itself, you can see that the name up here is California Residential Purchase Agreement and Joint Escrow Instructions. So if you hear the offer, the contract, Residential Purchase Agreement, RPA, those all mean the same thing, and it means this document here, which is what you write your offer on. Okay, so what is included here? This is a property from, you'd put your name, and this is the property to be acquired is the address of the house that we're writing the offer on, in the city and everything there. Now, this might sound silly, but somebody has bought the wrong house before, so we always want to make sure that we have the correct address on here. Now, as far as agency, yet again, we are saying what's called confirmation of who's who in the transaction. Who is the seller's agent and who's their brokerage, who's the buyer's agent and who's their brokerage. Those would be listed here again. And again, if it was dual agency, you would have, again, right here on the contract that it is dual agencies, that there's no way you did not know what was going on. Okay, second half of the first page. This is where we're going to break down what I call like the meat and potatoes of the actual offer itself. It's kind of like the financial terms. So the first line is the price that you're offering. So whatever you're offering to buy the home for, that'd be the price. Then the next is the close of escrow. So this is where, and I'm going to repeat myself several times here, but this is where we want to make sure that we are writing the best possible offer everywhere. And we want the seller to like everything about our offer except for the purchase price. Our goal is to have you be able to write a very aggressive offer other than just paying the most money for the house. This is one of the this overall concept is how we save our clients tens and tens of thousands of dollars when purchasing a home. It's because there's 150 different terms inside of the real estate deal. Most people only focus on one, which is price. However, let's go back to close of escrow. So there's two different aspects to close of escrow, or just the word escrow as a whole. Number one is it's a company. So what is escrow? Escrow is what I explain is the neutral third party accountant in the middle of the transaction. So you've got buyers on one side, buyer and buyer agent. You got seller and listing agent on the other side. They all send paperwork. Once everything's agreed to, escrow is who handles all the finalized paperwork and all the money. And they don't disperse anything until all parties agree on everything. So that's what is escrow. The other part is the timeline. So as you can see here, there is a fill in the blank for days after acceptance. So what would happen is if we were writing an offer today and it got accepted tomorrow, we would open escrow. And there is a timeline for that when you write the offer. Now, a normal timeline, I say to expect a 30-day timeline from opening to closing escrow. However, you can make a short timeline. So for example, if you're looking at a house and maybe it's vacant and the seller wants their money as fast as possible, if you're working with lenders that are really competitive and aggressive, meaning that they're doing their job ahead of the time, which we'll get to lending later, you might be able to close in 10 to 15 days as opposed to a normal 30. 45 to 60, 45 would be long, 60 would be incredibly long. So if you're kind of timelining out, plan on a 30-day escrow, 15 days would be fast, 10 would be incredibly fast, 45 is long, 60 is really, really long. So those are kind of the basics. And again, what you want to do here is you want to be as flexible as possible to what the seller actually wants. Again, if there's a vacant house and they want their money right away, and if you are able to close in 10 days and the competitor also writing an offer needs 45 days to close, that means they would be closed with you 35 days before the other offer. You're probably going to be able to get a lower price because of that. Again, this is one of the many tactics we use to save you tons of money. All right. The next thing is the expiration of offer. This is normally, again, if we were writing an offer today, normally it would expire 3 days after we send it. That's standard per the contract. However, again, we can use this to maybe give them a little bit more time if we're giving a little bit of an aggressive offer on price. We're trying to get a lower price. Or if we know we're coming in with a really strong offer, we might ask them to respond faster so they can't leverage our offer to get better offers, right? This is a different strategy. Now, the first thing that happens, the next thing on here is the initial deposit amount. So if we were to write an offer today and it gets accepted tomorrow, the first thing that happens, we open escrow, and then the next thing that happens is the initial deposit, or also known as the earnest money deposit. If you see EMD, that's also the same thing. So what this is your good faith deposit to put into escrow to show that you're serious. The earnest money deposit should be 3% of the purchase price. And the reason that it's 3% of the purchase price is because in the event of you canceling escrow after all contingencies are owed, which we haven't got to yet, we'll get there. But if you were to go through the entire, Let's say you had a 30-day escrow, you were going to go 29 days, and you decided to cancel the day you were supposed to close, and you'd already removed all contingencies. And you only put a $1 deposit down. The seller can go after the buyer for no more than 3% of the purchase price for what is called liquidated damages. So, and I know we haven't got to contingencies yet. We will cover this in great detail. But there's no harm or no foul. It's not an additional fee or expense. This is just you putting money up on the table and showing that you're serious by putting up that 3% earnest money deposit. Now, is 3% required? No, but for example, I'll exaggerate to make the point. If you were to offer a $1 deposit, you would be showing the seller that you're not serious at all. So by putting the 3%, you're showing the seller that you're serious and moving forward. That's the initial deposit. This is also on the contract to be done within 3 days. And if you've ever wired money before, you know that it does not take 3 days to wire money. So we always tighten this down to 1 or maybe 2 days. And it's just showing the seller with even more confidence that we're going to get them the money into escrow and we're very serious. We're going to close this deal. Again, all of these things hopefully help us chip away at that purchase price. Now, the next thing we're going to do is the loan amounts. We're just sharing with the seller what our loan amount's going to be, which tells them how much down payment we're putting. Also, what type of loan. Is this conventional? Is this FHA? Is it VA? Whatever type of loan we're putting in here, we would type in. And then whether this is our primary, secondary, or if it's an investment property. Now the whole first page is concluded there. Now, normally I'd ask questions on every single page, but because you're not here today, if you have questions, throw them in the comment section and I will personally go in and answer them. Hey, if you are enjoying this so far, I have even more information for you. Go to 7savingstrategies.com. You have the full guide, including a recording of this as well too, with even more resources. You've got everything that we do with all of our clients. And if you want to get that, go to 7savingstrategies.com and fill out the form. If you want to book a discovery call with one of our local experts, so we can get to know you in your own unique situation, you can do that there as well too. So if you want to do that, go to 7savingstrategies.com and we'll see you after this video. So let's go ahead and move on. All right, so that brings us to our offer package. Now this just shows us what is actually included in the offer itself. We do not just punt over a email offer and hope for the best. We put a package together to make you look as good as possible. So what is included? Number one is a competitive residential purchase agreement or a competitive RPA, which we're going through now. We also include a pre-approval and hopefully a fully underwritten approval letter. We'll get to that in a second, what those differences are. But we're also going to show proof of funds. We're going to show proof that you have the money that you need to close the deal. And last but not least, we include a love letter talking about how easy we as a company and as real estate agents, how easy we are going to make the seller and the listing agent, how easy we're going to make their life, right? We want them to be like, hey, this buyer and this agent, they really know what they're doing. So that's what's included in the offer. Now, probably one of the most important parts of the entire transaction is the financial side of it. Now, if you're paying cash, you can skip past this portion. However, you might still want to listen to the number 3 fully underwritten approval letter, because that is how we represent buyers that have as little as 3% down and compete with cash offers. So let me explain. So there's 3 different types of approvals before I move on. And these go in order of worst to best. Number 1 is the pre-qualification. This is the can you fog a mirror pre-approval letter. I use the kind of a joke. Basically what this means is the borrower had a phone conversation. Well, I'll explain in a minute. So you have the pre-qualification, you have the pre-approval, and then you have the fully underwritten is by far the most powerful of the 3. So the pre-qualification, like I said, is the kind of the fog the mirror approval, where you had a conversation with somebody that is a lender and you said, hey, I make about this much money. I've got this much money saved. I think this is my credit score. How much house can I buy? And they'll give you a number and they'll write down it on a piece of paper. And that means absolutely nothing. What this actually does is, and let me be clear, if you are early on in the research phase, get a pre-qualification. You have a conversation, make it super easy. And honestly, if you want to do this, go to onyxhomes.com/finance, play around with the mortgage calculator so you can get an idea of where you're at, but fill out the form and you can get a pre-qualification with no credit pull, no nothing. This is for the I'm in research phase. However, if you're writing an offer with a pre-qualification letter, what happens is you're announcing to everybody that sees this letter that you're not serious. And I, more often than not, when buyers, let's just say, refuse to take our advice and submit an offer with a pre-qualification, more often than not, we get a phone call right away that says, hey, why hasn't your buyer got approved yet? The seller won't even consider the offer with a pre-qualification. That is how low status a pre-qualification is. Okay. Now, number 2 is the pre-approval. This is the gold standard and has been forever in the real estate industry. This means, and what a pre-approval actually means, it does not mean that you're approved for the loan at all, at all. All it really means is the lender, you filled out a loan application, the lenders run your credit, and they might have started to collect some documents, which is a fancy, like they call it processing, which is a fancy way for just getting your paperwork basically. And then the lender looks at that paperwork and then they say, okay, you're approved for this much house. So there's way more validity to this than there is a pre-qualification. Literally means nothing. You could tell them you make $2 million a year, and if you make 200 or 20,000, they wouldn't know any different, right? Because it's a verbals, right? So the pre-approval, they've at least run your credit. They know that you have a credit score. They know who you are. They see the application. They maybe started collecting some documents, but this does not mean you're approved for the loan. Now, you can talk to several different lenders, and they're all going to give you likely different pre-approval loan amounts. Now, why is that? It's because it's not 100% accurate, okay? That's one major point I want to make here, because so many people have this misconception like, oh, I'm pre-approved, I'm ready to go. And let me share a story. As we just this weekend, we had a buyer that they were pre-approved with one lender for $950,000. They're approved with another lender for $1.2 million. Is it because one lender is better than the other? No. It's because one lender, they did a pre-qualification, and one lender, they did a full pre-approval. So the pre-qualification lender, if that buyer had gone out and gone shopping for 2-3 months with that pre-qualification letter, they would have likely fallen in love with a house that was $200,000 or $300,000 out of their budget. That is such a disservice to the consumer, which is why I talk so, I'll say negatively or maybe adamantly that you really do get a full pre-approval when you are serious. Okay, so the pre-approval has been the gold standard forever. Now, I'm going to explain the mortgage, like what happens in a mortgage timeline, the approval process, while explaining what is a fully underwritten approval letter. And what you'll see here is it is so much more powerful than any of the other two. So why is this important? So I've got I hope you can see my mouse here, but number 1 you've got is the pre-qualification. This is where you haven't even started the process yet. You're nowhere on the timeline. So you're before loan processing, which is the fancy word for collecting documents. So number 2 is you have submitted documents, right? So you're right here. Number 2, you're in between loan processing. So you're in between them collecting documents. They might have collected some, probably not at all. And then in between that and underwriting. So another major misconception is you as a consumer talk to Bob, the lender, and you think Bob is the one deciding if you get the house or not, or get the loan or not. And he's not. He's the loan officer. His job is to package up your information and send it to the underwriter. Now, that underwriter might be in the office with Bob, or it might be in New York. And the timeline of how long things take is going to depend on the company that you choose to go with. I will explain that in a second here when we talk about the real differences. Now, that's number 2. Now, a fully underwritten pre-approval, this is the third one, number 3 here, is the lender is ready to fund the loan for you. You just need to find the house. So that means that the loan processing is complete. So you did your pre-approval. They asked you for all your documentation. You sent them all your documentation. They sent it to underwriting. The underwriter probably sent it back and said, hey, I need some more stuff. And they sent it again. And then the underwriter conditionally approved the loan. So you are literally ready to fund the loan. You just need a house. Okay, so that is the third and by far the most powerful. And I'll share with you why it's the most powerful. So here are real life offer contingency timelines. And I know we haven't got to contingencies yet, but this is where we start kind of understanding them. So on a pre-qualification, your offer, you're probably going to need 30 plus days, 30 to 45 days to close the deal because you haven't started the loan process yet. You're going to need likely 17 or more days, meaning 2.5 weeks to even find out if you're approved for the loan, to even have a shot of buying the house. That is how, that would be the terms you'd have to offer in your actual offer if you had a pre-qualification. Now, if you have a pre-approval letter, the terms you can write in your offer are better than if you were pre-qualified. where you could close in maybe 25 days if we're talking very fast, up to like 45 days with more of a normal lender. Contingency timelines are going to be 12 to 17 plus days for your loan contingency. Your appraisal is going to take 2 weeks at least. And this is the most common by far. Now, what really the lender's saying with the pre-approval is, let's run your credit. Let me see a bank statement or a pay stub so I can see an idea of how much money you make. And then I'll give you a pre-approval letter. Go shopping with a realtor. Go write offers. Get your offer accepted. And then I will start doing my job. That has been the gold standard forever. And what happened in 2020 and 2021, when the market was super competitive, is we had to go find the very small percentage of lenders that will perform on time and be fast and underwrite a client up fully upfront. Most lenders, I would honestly guess 95% or more lenders do not fully underwrite up front because it costs them money. It costs them time of employees and it costs them money. So the fully underwritten approval, let's go down to the bottom here. You can close escrow 14 days or sooner. We have closed escrows, and let me give some context here. You could be putting 3% down with a loan, and you could be buying a house, and you can close in 14 days. The biggest benefit of a cash offer is the certainty that that deal is going to close. So if you are taking a cash deal can close in 10 days, and a 3% down payment buyer can close in 14, you're taking away a lot of the leverage that cash buyer had. Now, if there's no other cash buyers, then you have other buyers that are pre-qualified and pre-approved, but you can close in 14 days. Mind you, you also likely don't even need a loan contingency, or you need a very short loan contingency of maybe 5 to 7 days. And these lenders are likely local as well, and they can get appraisals returned in 5 to 7 days, meaning that you can write a all contingencies removed offer within 5 days, and you can close in 10 to 15 with a 3% down loan. Now, I'm using the 3% down loan because that's kind of the lowest down payment option. There's VA with a little bit different, but my point is you can be financed and you're not anywhere near a cash offer, and you can have almost the same terms as a cash offer has. This is one of the most powerful ways to save you tons and tons and tons of money. Does it take a little bit of extra work getting fully underwritten approved up front? Yes. Is it work you are going to have to do anyway? Absolutely. It's much less stressful to go through this process beforehand than it is after the fact. And the story that I shared earlier of a client we just were dealing with this weekend that was approved at one lender over here, and you know the name of this bank, and they said, yeah, sure, you can buy for 125. And the real fully underwritten approval said 950. This buyer thankfully hadn't started looking yet, because otherwise they'd be looking and probably would have fallen in love with something they never could have bought. Not never, but like they could not afford at the time. So that's the big difference there. So now we're going to talk about how we keep you protected through the entire process. So there's really 3 different major contingencies. You've heard this word a few times. There's a few different contingencies. And really what a contingency means is we are making an offer that we're going to buy a house for this much money. And that deal is contingent upon these things happening or us being okay with some things we find out. So for example, there's 3 major contingencies. You have what I call your homework phase. You have your appraisal and your loan. The 4th one is possession. We'll talk about that a little bit. It is technically a contingency. Okay, so let's dive into number 1, the homework phase. So number 1, on the screen here, you can see all the way from investigations, seller review of seller documents, preliminary title report, common interest disclosures, review of leased and liened. This is just a lot of, this is your due diligence as the buyer, okay? So here's how I break down the homework phase. There's 2 parts of this. Number 1 is you go out and do your investigations, right? You're going to do your inspections on the property. There are 4 that we adamantly recommend, and if you don't do them, we will send you a very strongly worded email saying how strongly we recommend them. And then you can do as many as you want. There's millions of inspections. You can do 2,000 or more different inspections. It's totally up to you. The goal of the homework phase is for you to understand what you're buying. Okay, so let me kind of paint a picture here. Is maybe we're out looking at properties and you see a house you really like. We spend a half an hour in there and you feel like, you know what, Christian, this is the house we want to write an offer on. Perfect. Well, we've spent 30 minutes on in the house, and we're going to write an offer. And then once we get the offer accepted, we're going to open escrow, we're going to do our deposit, start the loan process, and we're going to start our homework phase. So what this means is we're going to schedule our inspections. The 4 that I mentioned. Number 1 is the physical inspections. You're going to hire a general physical inspector. We have referrals. You can use whoever you want. You can just Google if you don't know and you don't want to take our referrals, it's fine. You're going to find a general inspector. Number 2, I'm going to go through them, then I will explain more. Number 2 is you're going to get a roof inspection unless they do both. The third is you're going to get a termite inspection. All houses in California have termites. It just depends on how bad and how much money it's going to cost to fix it. It's not that big of a deal. It's just money. Not that money's not a big deal. You get my point, I think. Number 4 is a sewer inspection as well too. These are the 4 major ones. And what we have found is between your due diligence here and reviewing everything the seller gives you, you're going to have a pretty good idea. Or you do these 4 inspections and then you might find other issues where you might go deeper and hire out for more inspection. Okay, so let me dive through the 4. Number 1 is the general property inspection. This is, and I'm going to explain this as simply as possible, is where you hire an inspector to go out and they walk around the house with, think of like a little red flag. And anything that they see that might be concerning, they'll raise that red flag. Now, they're not an expert in any of these fields, but they should know that, hey, the air conditioner is not blowing as cold as it should. You might want to have an HVAC, so heating, ventilation, air conditioning. You might want to have an HVAC specialist come out and take a look at it. And that might be an extra inspection that you do, is you might get a quote for an HVAC company to fix the AC. That's like the most common thing we see, literally like in every house. The AC works, but it's old and might blow up any minute. So we like to get quotes on what it's going to cost to fix or repair or whatever might happen. So the inspector's going to go through the entire house and do that with the plumbing, with the wiring, with the outlets, with, this doesn't look so right, the roof, the whatever, all the stuff, right? So you're going to get a better idea of what is going on with the home. And if they inspect other inspections, that's up to you to then go and do more due diligence, right? Do more homework. Okay, general property inspection. Number 2 is the roof inspection. Same deal. If there's anything wrong with the roof, how much is it going to cost to fix it? Number 3, termite. Again, every house has termites. It really just depends how much it costs to fix it. So how much is that going to cost? And then 4 is the sewer inspection. The reason we've added this in the more recent years is because it's not a problem very often where the sewer basically going from the house to the street is a problem. But if it is, it's a huge problem, like $25,000, $50,000 of problems. So we advise all of our clients to do that inspection also, because we've had enough clients save $25,000 to spend the extra money to do that. Now, this is all of this that I just mentioned, as many as you want to do, as many inspections, this is all your cash out of pocket during the escrow period. Okay, just to be clear there. You need to do as much homework as possible so that you feel comfortable buying the house that you chose, right? This is all your time. And one thing that I also say, which I'm going to lead, so the one thing is inspections. The other thing that happens is basically your document review. So review of seller documents, your title report, common interest, which would be like HOA, stuff like that. And then lease lien items like solar, stuff like that. Right, basically, so over here you have your inspections, and over here you have all the paperwork, basically. Now, one thing I'm crystal clear with all of our clients is we do not read every single word of every single thing that comes to you, nor do we get everything that comes to you. What I mean by this is, just if we did read it, if we read every word of everything, we'd never get anything done. That's number 1. Number 2 is, just because we read something and don't think it's a problem doesn't mean you wouldn't. So how we do this is, you as our client, you would go through and read everything, going through all the paperwork, and it is your job. It's a lot of work. Yes, it is. But you'd go through and read everything. And any type of question, comment, concern, you bring it up and you raise the red flag to us, and we'll get those answered. So if you say, hey, Christian, I'm concerned about this thing that the HOA says, you would put that together and you would say, hey guys, I got questions on, and I say, hey guys, like our team, hey, I got questions on this thing over here, and we'll dive in and get all the answers you need. Okay. So these are the 2 things that happen at the same time. I will talk about timelines, and then I will talk about what happens after. But first, one thing that's not on here is insurance. we know the wildfires, we know everything that's gone on with it. Like, insurance has been a huge headache for homeowners insurance for the last several years. It's not just because of the fires. There's a lot of stuff going on in California, where homeowners insurance is harder to get. It's a little bit more of a pain to get, and it's a little bit more expensive than it has been in the past. So the minute let's say we're writing an offer today and it gets accepted tomorrow, you should be starting your insurance homework now, just like you should with your pre-approval. If you're just doing super early research, just call your insurance agent and say, hey, or email whoever it is, right? Reach out to your insurance agent and just tell them you're looking to buy a house, and then get information. You might need to talk to several different companies, just like a lot of buyers talk to several different lenders. I would look at these the same way, okay? So that's your homework phase. You're going to do all your inspections, and you're going to do all the reading, right, and get all your questions answered. Now, at the end of this homework phase, let's talk about timeline first. So as you can see, time to remove contingencies, these are timelines here. You can see 17 days is written into the contract. Now, what we talked about might sound like a lot. It does absolutely not take 17 days to go through this process. It takes 7 days on average. No, I shouldn't even say on average. 7 days is comfortable. 5 days is fast. 10 days is long. This is how we explain to all of our clients. Now, if you walk into a house and everything's wrong with it, okay, maybe we need some more time. But if you're walking into an even average house that looks a little beat up, 7 days is normal, 5 is short, 10 is long. And the reality is, you just, for the first week that you open escrow, so again, if we wrote an offer today and it got accepted tomorrow, you would do your deposit and we'd start our homework right away. Meaning we would have our inspections scheduled on day one to be ASAP. You would be reading everything as you received it, and you go through the entire process. Okay, so that's timeline. Again, when you're writing your offer, you want it to look as good as possible everywhere except for the purchase price. Let me zoom out, and I'm going to continue here, but let me zoom out really quick because this is incredibly important. Is if you're a seller and offer number one is pre-qualified, so they need 45 days to close, and they need 17 days to do their homework. 45 days to close, pre-qualified, and they need 17 days to do their homework. And you are a very smart home buyer, and you are fully underwritten. You can remove all your contingencies in 7 days, and you can close in 14. Who are you as the seller? And the same price, let's just say. You're the seller. Which one of these offers are you choosing? You're going to choose the one that's going to close before this person wouldn't even tell you they're moving forward before this person is closed. Now, the question is, how much lower can this person's price be? This person's price, in my experience, can be $10, $20, $25, $50,000 less than this price because there's more certainty here. This is why cash buyers get better deals, is because there's more certainty. However, I've also seen cash buyers that write terrible offers and pay more money, and certainly pay more money than they need to. So this is why this is so important. So your homework phase, and again, ask your agent on your particular property and all those different things. But 7 days is normal, 5 is short, 10 is long is the advice here for your homework phase. Now, at the end of the homework phase, okay, we've done all the inspections, you got everything, you read everything, we're okay. You can cancel for whatever reason. So if you just be like, you know what, this house is way too much work, Christian, I'm out, I hate it, I don't want to deal with this. That's fine. You can cancel the contract. You can use your inspection contingencies to cancel the contract. No harm, no foul. The only money you'd be out is the money you paid for the inspections and the appraisal, which you would have already ordered by now. However, the money that you would have invested there, which may be $1,000, $2,000, maybe $3,000 if you went crazy on inspections, that $3,000 of loss is way better than buying a home that you should not buy. Okay, or at the end of your homework phase, so 7 days into the deal, you say, hey, you know what? I like this house. I'm ready to move forward, but I didn't know the air conditioning was about to blow up, and I want that fixed in order to move forward. And maybe it's $5,000. So you now do, at the end of the homework phase, we do what is called a request for repairs. It is just that. It is a request to the seller. Now, there's a couple different ways to structure this. Basically, what this means is you say, okay, seller, I am comfortable buying your home, but only if you fix the AC. Now, there's a couple different ways to do this. You can ask them to fix it. You can ask them to credit you money towards your closing cost. so that you could fix it after it closed. You could lower the price, or you could do any combination of those. I think I hit all there's 4 different options. So here, what will actually happen is you will choose what makes the most sense for you. Now, I'll give you a very quick pros and cons of kind of each. If you ask them to fix it, you can pretty much be guaranteed that the seller is going to do the cheapest possible way to fix it. So if you're going to do that, when we write this in our contract, we want to be crystal clear of how exactly we want it done. So how we would do this for our clients is we would get, let's say it's the air conditioning. It's just an easy example, super common, is we would get a trusted HVAC company to give us a quote to fix it. And in the repair request, we would say, execute this quote, meaning the seller needs to do this quote. What is quoted by, what is it recommended or whatever by this particular company that you chose as the buyer? You want that done. Okay. Or, so that's option number 1, is you ask them to fix it, and you want to be smart with how you ask. Option number 2 is you can ask for a credit. So let's say that invoice was for $3,800. You could ask for $3,800 credit. You could ask for $3,000 credit. You could ask for $5,000 credit. The point is you can ask for money towards your closing costs. So basically it saves cash in your pocket, and then you can do whatever you want with that after closing. You can fix it, or you can not fix it, or do whatever you want. That's number 2. Number 3 is you can ask for them to lower the purchase price. The reason this isn't very popular, unless you're paying cash. If you're paying cash, that's definitely the way to do it. The reason this isn't very popular is because if you lower the purchase price by, let's say, $5,000, regardless of the purchase price, it doesn't really affect the payment very much. I would rather have cash in my pocket rather than, $4 less on my payment. That's just my personal opinion. Most people choose to either have the seller fix it or to do the credit. Now, those are kind of the pros and cons. The pros and cons of the credit is it could cost more, right? So the HVAC company might go in there and be like, we found more problems. It's actually $8,000, not $3,800. And the deal's closed, it's too late. And you might be able to say it's their fault or whatever, but that's is what it is. If you ask them to fix it and they find those extra issues, they'd actually then it's kind of on them, right? They don't necessarily have to do it, but it's more on them than after closing. That's the pro and con of the credit. So that's your homework phase. So we're 7 days into the deal, or 5 or 10 or whatever. We're 7 days into the deal, and you are saying, hey, this is your last, we call you, our client, if you're working with us. If you're not, hopefully you remember this stuff. But we call our clients before we do our repair request, and before we move this in the homework contingencies. We say, hey, this is your last chance to have any cold feet or second thoughts. And if you're like, hey, you know what, I'm not sure how I feel about this, our advice is always just cancel the deal. We would hate for you to buy something and then regret it a month later. So at this point, we're saying you're most likely going to be like, hey, yeah, you know what, if we get this repair request, I'm good to go. So before we do all that, we want to make sure this is the right house, because there's no backing out after. There's no harm, no foul after this. So when we send over the repair request, the seller can say yes, they can say no, or they can counter, or they could not respond, which is a no. So we want to make sure we're structuring the repair request in a way that's going to get us the most possible. I always say this: silly offers get silly responses. If you had only thing wrong with the house was $3,800 HVAC repair and you asked for a $50,000 credit, they're probably just going to say no. If you ask for a $3,800 credit and there's $3,800 worth of work that needs to be done, that probably gets accepted, right? That's kind of the example that I get. So if the seller says, yes, you are moving forward, your inspections, your contingencies are removed, we're buying this house. All we need to do is loan an appraisal, which we'll get to in a minute. If they counter, you can go back and forth. And this is where you choose that maybe this is a good fit, maybe this isn't a good fit for you, right? And then the situation, as far as the dollar amounts and all that, totally depends on the situation. We've seen repair requests for hundreds of thousands of dollars. We've seen it for zero. And everything in between, right? There's all kinds of stuff that can happen. But that's your homework phase. This is probably the most important part of the whole deal, the whole entire everything we're talking about today. And the next two are much easier because it's going to completely depend on the lender you choose and the type of pre-approval you have beforehand. So for your loan and appraisal contingencies, you can see up here for timeline. You also have a 17 days after acceptance is the standard. Does it take 17 days? No, it does not. You should be doing this beforehand. You should be getting fully underwritten ahead of time so that you likely don't need a loan contingency. And if you do, it's 5 to 7 days. And for an appraisal contingency, you need to work, you don't need to. You should, in order to write the best offers possible, working with a mortgage company that is going to get appraisals done in 5 to 7 days is going to make your offers incredibly more competitive. So again, for loan and appraisal, it is 100% dependent upon the lender that you choose to work with. Some will take longer than 17 days to do the loan contingency, and some don't need it at all. Some need 5 days to get an appraisal back. Some take 3 weeks. It totally depends who you choose to work with. Small piece of advice, but first I will just say that we have recommendations for the lenders that we've done tons of business with, that we know get the job done, are super good for customer service, and are very competitive with their pricing, meaning rates. So if you want those recommendations, ask and go to onyxhomes.com/finance, play around with the mortgage calculator, fill out the form, and we'll make an introduction there. You can do that too. The general rule of thumb is the bigger the bank, and you know, like Chase, Wells Fargo, Bank of America, you could pretty much guarantee that they're going to be slow. Small, like local lenders are likely to be slow as well. There is a sweet spot of mortgage companies that what they do this. They don't like banking, they do mortgages, and they're much better and faster, and that's generally the best companies to go with. So anyway, that is your homework phase and the repairs. That's the big chunk, the meat one. And again, please underline this. Get your insurance process started earlier and get fully underwritten. I know this is a ton of information, and if you want to get it more downloaded so you can come back to it later, go to 7savingstrategies.com. I've got a 125-page document that goes through literally everything we're talking about here today, as well as a recording for this as well too. And if you want to book a call to talk with one of our local experts so we can talk about your situation, I'd be happy to help you out with that. Go to 7savingstrategies.com and we'll see you there. Again, back to the video. Number 2 is the appraisal. What an appraisal is a neutral third party's opinion of the value of the property. Now, the lender is going to use the appraised value as what the value is. It doesn't matter what you offered. They're going to look at the appraised value, which is also why you don't want to have a lender that is a small bank in New York doing appraisal in Southern California. They likely don't know Southern California very well. So you're much more likely to have appraisal problems with larger institutions or institutions that have that do not do business here. Again, we have all the referrals that you could ask for. Anyway, that's what an appraisal is. And what the appraisal contingency says, that you're willing to buy the property at the price you're offering, but if the appraisal comes at a lower value, you can still cancel. So let me exaggerate. Let's say you're buying $1 million house and it appraises for $800,000. You can cancel the deal because in all likelihood, that'll totally screw up your financing. What is more likely to happen is there's a renegotiation of some sort between the buyer and seller. The difference here is usually not that big in most circumstances. It can be a huge difference, but it's not always, right? There's a lot more information I can give you on an appraisal contingency. It really depends on your unique situations. I won't go too much deeper there. And the last one, number 4 here, possession. This is just when you get your keys. Now, there are some negotiation here as well too about a seller staying in the property after closing. This is what's called a seller rent back or a lease back or a seller in possession. There's a million different ways that this can go, and it's not required by any stretch of the imagination. But if a seller, I used the example earlier, that the house was vacant and they want the money as fast as possible. Well, the other end of that is maybe the house isn't vacant. Maybe they have a lot of stuff to move and they need like an extra 2 or 3 weeks in order to move to their new home. So maybe the seller is going to want a 20-day close and then have 20 extra days in the house so that they can move after they've closed, right? Those are different circumstances. Here's some quick, easy hitters on how to negotiate this. Find the market rent for the home and charge that on a per day basis was one way. Another way is whatever your mortgage is, which is likely higher than the rent, you figure that out on a per day basis. Those are the easiest ways to do it, or you can incentivize the seller to close easier. Again, there's 100 different ways to save money and negotiate here. I don't want to make this video 17 hours long, so I'm gonna move on. But that is one of the biggest part is your contingency periods. To where very realistically, is if we saw a house today and we liked it, we wrote an offer and it got accepted tomorrow, you would do your deposit the next day, and then for the first 7 days, if you're writing an aggressive offer that saves you money, You're going to be doing your homework for the first 7 days while the lender's doing all the lending stuff. You're getting the appraisal ordered to where on day 7, you know if you're buying the house for sure or not. And then from day 7 till whenever it closes, it's kind of like hurry up and wait. Like a lot happens in the first 7 days. It's definitely stressful. I won't say that it's not. But after those 7 days, you know for sure you're buying it, you know for sure approved, you know it appraised. And it's just kind of like, when is that closing date again? When is that? Gosh, wow, we have another 10 days and you really don't have to do much of anything. Sign paperwork, DocuSign, stuff like that. But there's not really anything major that happens after that. In the home buying process, really, frankly, is that easy. Write the offer, get it accepted, do your earnest money deposit. The first 7 days is your homework phase. Your loan's getting approved. You're doing the appraisal. After that, on a 30-day close, you might literally have, 23 days of literally waiting. And there's some paperwork and signing at the end. And then you get the keys and you're super excited at the end, right? So the process really isn't that complicated. There's a lot that happens at the beginning, but that's the major point. Okay, let's continue. So what is included versus included in a house? This is an interesting one. If it is fixed to the house, it is included unless the contract says otherwise. What that means is if you see something bolted onto the house, attached to the property, drilled into the whatever, attached, it is included. If you see something that you could just pick up and move, like a pot, for example, or plant, whatever that's in a pot, is not included. If you have like a fridge, for example, could be either way. The fridge, you might just be able to pull out and unplug and unscrew the water, and that's not included. That is personal property. However, if it's one of the built-in refrigerators where you'd have to remove cabinetry, that is included. The stove is often, unless it's a stove top, obviously that's included. The stove is technically not included, right? If you can pull it out and unplug it. So that's why you want to make sure you're checking off all the things. Again, your agent will do, if you're working with one of our agents, we will make sure of this for you, that you're getting everything you thought you were getting and expected. If you saw something you didn't want, like the TV mounted on the wall, you wanted it removed, you could exclude things as well too. The TV is a bad example. But if there was something attached to the property you didn't want, you could say, hey, remove that thing, and assuming they accept that in the offer, you can have that as well too. So I hope that makes sense. Now, this major big thing here is rather simple. I have highlighted what is normally paid for by who. So this is who pays for what. I'm going to go through this rather quickly. All of these things really are part of what totals up to your closing costs, just the overall cost of buying a home. This does not include commissions or anything like that. This is just the cost of buying a home. And here are some of the things. Your natural hazard zone disclosure report is typically paid for by the seller. You want to make sure you're getting an environmental report, and this would be provided by whatever company. You are going to ask the seller to give you a termite report. You should. And you want to make sure it's if there's an HOA, you want to make sure it's the HOA approved termite company. The next thing is you're going to tell the seller that you are going to be paying for a physical inspection. You want to make sure the seller is paying for your carbon monoxide detectors. These things here are really kind of just for LA, to be honest. But the seller would pay for these guys as well. I forgot to highlight that. Escrow fees, each should pay their own, meaning the seller pays the seller fees, the buyer pays the buyer fees. Generally speaking, seller fees are a little bit higher than buyer fees, so this is good for the buyer. And the escrow company and title company are typically chosen by the seller and the seller's agent as well too, just for the record there. The owner's title insurance policy is usually paid for by the seller. The buyer's lender's title insurance policy has to be paid for by the buyer. The city and county transfer tax fees are paid for by the seller, should be or usually are. HOA prep fees have to be paid for by the seller. HOA certification fee has to be paid for by the buyer. HOA transfer fees should be paid for by the seller. And private transfer fees or like enhancement fees would typically be paid for by the buyer. And then we'd obviously tell you how much they were there. And then anything else random here, and then home warranty. So normally we are able to negotiate for the seller to buy you a home warranty for your first year living in the home. The company we like to use has a 13-month policy, gives you 1 extra month. And that's really the major who pays for what. Now, lastly, I want to help you with your budget. So we want to make sure we cover a couple terms. So you have your down payment and you have a closing cost. So for example, if you're putting 20% down, you could expect another 2 to 3% in buyer's closing cost. Kind of depends on your lender. and that totals up to your total cash to close, right? So if you're doing 20, let's just use this example. If you're doing 20% down, you would have 3% in your earnest money deposit right up front. So that means you have 17% of your down payment still due, and then you have your closing costs as well too. So you do your 3% up front, and then when you go to close the deal, the total cash to close is the rest of your down payment plus all of your closing costs that you wire in at the end of the day. Okay, so that is some terminology there as well too. The last slide here is it's easy, right? I know this is ton of information, and there's a few things that I want to point out here. One, you are so far ahead of the competition by doing this. I want to make sure that you know that most people do not go through this type of an education process. Most of our clients literally take all of our advice through this, and those are the clients that save the most money. There are some other clients that don't take the advice. They do whatever they want with it. At the end of the day, our job is, as your buyer's agent or seller's agent, our job is to make sure that we save you the most money, we get you the house you actually want, and we protect you through the entire process. Now, I know this was tons of information, so I want to give you more resources to get better help. If you want to get this entire recording and a full PDF doc where there's 126 pages going through it, go to 7savingstrategies.com and drop your information. We'll send you the whole guide. You'll get a recording to this as well too. Now, also on that page, you're going to be able to book a call with one of our local experts. So if you want to talk about a quick discovery call, just how we can learn your unique situation, see how we can use these strategies to help you save tons of money and stay protected, you can start all that by going to 7savingstrategies.com, downloading this guide, and then if you want to book a call with one of our local experts, we'd be happy to help. But otherwise, I appreciate you watching. My name is Christian, and I will see you in this next video.